Thank you for joining us this afternoon for an RIA's guide to harnessing behavioral finance. We've got a terrific program today. We've actually got the wizard of Adhesion Wealth Advisor Solutions, Barrett Ayers, to get on the line with us and give us some great insights about how we're applying behavioral finance to the evolution of our product and the evolution of relationships with your client. We've got Ty McDaniel, who's our Director of Sales, who will be filling us in on some very specific strategies and tools that you can use to help build better relationships based on that behavioral finance. Just a quick housekeeping item. We are recording this. You will receive a follow-up email from us that will have in it a link to listen to the replay. And if you've got questions along the way, use the question box in your GoToWebinar toolbox, and we'll make sure we get to each and every one of those before we log off. So welcome. We're going to dive right in. I notice a number of you on the call are new, and maybe you don't know who Adhesion Wealth is. Let's just start there for just a second. Study after study has shown that the industry's top advisors have discovered that it's really much more important for them to focus on delivering advice to their clients rather than focusing on managing investment services. Simply, there's more alpha in client relationship building and managing than trying to squeeze bips out of the portfolio. It really represents the driving force behind this explosion in wealth management. It's really what the consumer is expecting when they engage in those kinds of wealth management relationships. So that's the why behind what we do at Adhesion. The what is that we are specialists in delivering investment services on your behalf. And the way that we do that, the how, is through our open architecture, unified managed account platform. It really represents a UMA 3.0, if you will. It's a highly customizable platform. It uses web-based business intelligence dashboards to really help you and your clients gain deeper insight into what's going on, not only with their investments, but really how they're tracking relative to their goals, which, as you know, is a key part of this relationship. We currently have assets under administration exceeding $12 billion. We've been in business since 1999, and we're proud to say that we're 100% based in Charlotte, North Carolina. All of our development operations and support are all based there in Charlotte. So, having said all that, Barrett, there's been a lot of talk about risk tolerance since 2008 and 2009. Is it enough for advisors to focus on that?
Yeah, Jack. That's a great question. That's why we're all here today, right? I think what's important to understand is that it's more than just risk tolerance. Our objective here, and I think all of our objectives in the industry, is to ensure that our clients follow our investment advice faithfully and dutifully, and that it's important that we connect at a level that's more than just based around risk tolerance. And I think that's kind of that's a trend that's emerging. I think we're hearing a lot of people ask for it, understanding that there's new forms of competition, that there's a lot of folks out there, whether they be other advisors, different forms of advice, or even the robo-advice providers that are now seeming to emerge. There's a lot of competition out there. So it's important to develop a relationship with your client that's more than based on a questionnaire, that's more than based on traditional risk tolerance, and that it's important to develop this very emotional, behavioral-driven relationship with our clients. So I think the other point that's important, and probably goes without saying, we obviously didn't invent behavioral finance. All we've done here is really react to the market. So many clients, many of our folks we deal with, many of our partners we deal with have asked, we understand these behavioral predispositions and biases exist. What can we do to capitalize on them? What can we do to incorporate them into our practices on a day-to-day basis? So we've built a framework, which we're going to talk about here in just a moment, how to take standards, practices in behavioral finance, understand them, and weave them into your practice using a series of diagnostic tools that we're about to chat about. So with that, let's go ahead and get started. I think it probably makes a little bit of sense to kind of lay out ways that you can incorporate behavioral finance into your practice, and that kind of serves as the segue into what is going to be the action plan part of the presentation. So the first thing we talk about on the next slide is kind of a three-step process. I guess really the first in a three-step process. The first thing is basically planning for, anticipating, understanding behavioral biases. And you know, we've been told this in the past that this first bullet point here is a little bit controversial, particularly those of us who come from an investment background. But understanding your client's behavioral predisposition, the way they think, the way they process data, is just as important as their individual investment objectives. In fact, you might argue it might even be more important. The premise here is that if you don't understand how your clients understand and consume and process data and some of their biases, then delivering and ensuring that the investment objective sinks in and is achieved can't be recognized. So with that as kind of a backdrop, the second bullet is basically saying, well, what do we need to do? How do we take and understand our clients and understand their predispositions? And to do that, it's really important that we use what we call a behavioral diagnostic framework. There are multiple diagnostic frameworks out there. The one that we happen to kind of highlight here today is one called Behavioral Alpha. It was designed by a gentleman by the name of Michael Pompiane out of Mercer Hammond. And what he does is he goes through a series of questions and interactions with your client to understand exactly what their vulnerabilities are and their kind of behavioral predispositions. And through this series of questions, he attempts to categorize them and put them into 4 specific, discrete categories. With those 4 discrete categories, we can then build a plan on how we interact with them. And that's what we're going to talk about here. So the next bullet point then is basically talking about ways to collect the information to understand which of the 4 behavior types your client falls into. We happen to be in a very fortunate situation as investment advisors in that we generally tend to ask clients at least once a year information about their investment profile, about their risk behaviors and their profiling and their investment objectives. So generally you do this up front. Many advisors do it on an annual basis. So we have the opportunity to meet with our client and ask them questions. What we suggest here is that you expand the scope of the questionnaire beyond just traditional risk objectives. So add in there questions about behavior, about personality, about level of engagement. It's a great opportunity to expand that. And you see here, over here, and I think Ty is going to mention this in a few moments, we have a questionnaire, we have a profiling process. It can be, these behavioral type questions can be integrated into the questionnaire and can point you very specifically to the behavior type, which then kicks off a series of action plans. So let's talk about then these 4 behavior types and how we go through the profiling process. So the way we think makes a lot of sense. The first thing is to understand the client's level of engagement. And we measure that by degrees of participation. And we measure that on a spectrum of passive to active. And we don't mean necessarily in the way that their investments behave. What we're really talking about is the way their personality behaves. We're talking about what their interactions look like. Is this a client who is very hyper in their personality? Do they want instant information? Are they refreshing the market values of your web page on a minute-by-minute basis? Are they text messaging you? Or are they a little bit more laid back? They're a little more slow and steady. They understand their investment objectives, and they're going to sit tight and a little bit more passive in that perspective. So that can be measured through a series of questions in the profiling system. Then we're going to go in and we're going to then measure the degree of risk-taking. And that's probably a series of questions you already have today, whether it's electronic or paper-based. We think then integrating those risk questions, maybe a dozen of them. And then the next thing that is particularly unique about this diagnostic framework is what we call integrating in the emotional predisposition. And we measure that on a degree of emotional and cognitive. And obviously emotional is this client very gut-driven? Are they very instinctual in the way they make decisions? Or are they cognitive, very scientific and binary in their decision-making? And that, again, can also be judged and graded based on a series of 5 to 6, maybe 7 questions that can, again, be integrated into the profiling tool. So through this kind of thread-based profiling process, we can then map them, in this case, into the behavioral alpha for investor types. Now, again, this can be other frameworks, other behavior types. This works very well with behavioral alpha. So there's 4 basic behavior types. Once we have our clients in our behavior type, then the key is let's build a plan for each and every one of them. And when we talk about plan, we talk about not only how we deliver investments, we talk about how we talk to them, how frequently we talk to them. What do the deliverables look like? Is there a specific type of report that they want? How should we talk about the proposal? How should we build their portfolios? So it's an entire plan on how to capitalize and in some cases counterbalance their behavioral biases. So with that in mind, I was going to go through each one of these, each one of the 4 behavioral biases, and spend a little bit of time talking about them, helping you kind of visualize a persona for each one of these clients. You probably have each one of these clients in your practice, and you probably may get a chuckle out of some of the familiarity you may have with some of these. And then we're going to talk about things that you can do very specifically, very tangible takeaways on dealing with this particular client type. And then in terms of building a program, we're going to talk about some of the things that Adhesion delivers through our platform that can further support in deepening this relationship for that particular behavioral type. So the first one we call is the passive preserver. This is a client who places a tremendous amount of emphasis on financial security and preserving their wealth. Many have gained their wealth through inheritance, multi-generational wealth transfer, or maybe a really conservative, slow and steady investment approach. They tend to be very passive. They have a very low and conservative risk profile, and they're usually very emotional in their decision making. They tend to exhibit a trait called endowment bias, and you probably know these clients very well. They generally tend to have a very emotional attachment to objects. Endowment bias, when manifesting itself in investments, tend to look like clients who may inherit a low basis stock from maybe one of their grandparents from a while ago, and they have it in their portfolio and it's a really low basis, but because their grandparents gave it to them, they don't really have they don't really want to get rid of it. So it's this emotional attachment to an object, and again in this case it's a stock, let's say. So the key then is how do you kind of unwind that position and do it in a way that contributes to the betterment of the portfolio. So some of the advisor takeaways, things that we think you might want to consider as you're dealing with this particular client profile. Obviously, focus on the big picture. These clients are scared off and alienated in some cases by focusing on statistics and jargon and kind of nuanced investment discussions. Really important to focus on the basics: asset allocation, long-term perspective, goal-driven, and obviously they desperately need investment advice. So as it relates to kind of customizing a program for this particular client type, some of the things that we really recommend is developing what we call customized strategies. And in our vernacular, customized strategies doesn't necessarily mean every client has their own strategy. What it means is maybe that you take one of your existing standardized strategies, but maybe put some customization layers on top of it. Still the same basic strategy, but it's going to be customized for this particular client. What that does for a customized strategy, that ensures that we can get those low basis positions in there, and then maybe put in a method of slowly harvesting and then conditionally unwinding the low basis position. So doing some opportunistic harvesting. We also have the ability to integrate and absorb in some of the low basis positions into kind of a custom index, so that we have a very predictable tracking error core, and we can start to unwind those positions as we build up losses in the core portfolio, in the rest of the portfolio. So moving on to the next, into the next behavior type, this is a profile called the friendly follower. A little bit more passive. They still tend to exhibit a low to medium kind of risk profile, but these are a little bit more scientific in the way that they deal with things. You can think of this persona as the client who tends to follow the most popular or vocal source of investment advice, usually, frequently, without regard to your or any investment plan for that matter. So they may hear something on CNBC or maybe read something in the Wall Street Journal and then try to implement it the very next day. They tend to have a very scattered approach to their investments, a lot of disparate accounts all over the place with, last year's cocktail party ideas. And it's very difficult to kind of get them all put together and focused on the investment plan. One of the behavioral traits that they tend to exhibit is what's called cognitive dissonance bias. And this is a tendency whereby the client attempts to rationalize the decisions in an attempt to kind of avoid the truth. And since it was obviously printed in the Wall Street Journal, it was printed in Forbes, wherever they read it, they can justify and rationalize their behavior because it was there in print. It is one of the most difficult tendencies to overcome because you're dealing with fact-based information, or what appears to be fact-based information. So the way to kind of counterbalance that in the advisor takeaway section is to provide your own fact-based and educational-based explanations. These folks enjoy understanding information. They tend to read a lot. They tend to research a lot. So providing your own fact-based deliverables, discussing the benefits of diversification, and provide as much information to the client as possible. You need to be very cautious of all these disparate accounts because they tend to contribute to an overestimated risk profile because they're all going in different directions and they're not usually cohesively put together. In terms of an adhesion program and developing kind of something for this particular profile, a lot of our clients use core satellite. These profiles tend to enjoy core satellite type strategies. At least it kind of speaks to their persona. Because it is a little bit more sexy, it does tend to move around a little bit. It is certainly fodder for cocktail parties. Because they generally tend to have a bunch of accounts all over the place, the ability to put a wrapper on top of all these disparate accounts to kind of look at it from an advisory perspective, a unified managed household is a terrific optics tool to see what's going on underneath the covers. And also the ability to do current versus proposed reporting, or what we call away account analysis, where you can look at the accounts that you're managing, but then also look at, from a risk-reward perspective, the outside accounts that you're not managing, and show the client what the risk profile is of the combined portfolio as well as all the independent portfolios to show them kind of where their risk-reward, where they live on the risk-reward spectrum. So moving on to the next profile, this persona is called the independent individualist. And you probably have a lot of these in your practice. Some of these are the most challenging folks to deal with. They're very strong-willed, very independent. A lot of engineers tend to fall into this category in that they're disciplined and they do their own research. They also tend to think of things in a very binary, black and white scientific method, thinking there's only one right answer. They're also the ones who want to kind of open up the car, disassemble the engine to see how it works and see if they can put it back together again. They're very active in terms of their engagement, a little bit higher on the risk-reward spectrum, and generally, as you can imagine, tend to be a little bit more cognitive in the way that they think. One of the traits that they tend to exhibit is what we call confirmation or fitting bias, and this is a condition whereby the client seeks out facts to support their position, yet they ignore and kind of filter out, diminish the data that doesn't necessarily support their position. This is another challenging one, too, in that the best way to overcome this particular predisposition is by, again, providing as much education as possible. These folks are thirsty for information, right? They want to see how the machine is built. So it's not a bad thing to let them see it, right? So understanding asset allocation, principles, providing education as much as possible, fact-based deliverables, and definitely talk about the investment dialogue. Going into a little bit more statistics and jargon here is okay as long as there's some education behind it. But keep in mind they're not likely to adopt or embrace a plan. Having said that, in terms of the program, they will, if given the appropriate level of educational fact-based detail, they will likely adopt a standardized strategy. So if you can provide information on why your moderate growth strategy is well built and is structurally intact and makes a lot of sense, it's something that they very likely will adopt. We also think that, again, showing how the engine is built is a good thing. So the ability to, if you have a client portal or if you have a reporting capabilities, to show program visibilities, things like sleeve level returns, attribution within an account, and things like that make a lot of sense. We also think that a little bit more active reporting profile for this client makes a lot of sense. So if you want to provide a client portal or send out monthly reports or provide access to maybe even sleeve level performance, things like that, with the right profile, obviously makes some sense here. So moving on to the very last type, client type, this is called the active accumulator. This is a client who is very active, very emotionally charged. They often tend to be entrepreneurs or physicians. They tend to believe that their own personal success they've created in their lives can somehow be replicated to achieve financial success. We obviously know that that doesn't usually translate well. Plus, they're exceedingly, in many cases, overconfident and can be very difficult to guide. Again, they're very active. Risk profile, as you can imagine, entrepreneurs frequently rolling the dice, very high tendency, very high appetite for risk, and they're all very emotionally charged as well. Some of the behavioral traits that they exhibit, one that we focus on right now is what we call illusion of control. This is a condition whereby they believe that controlling or influencing a series of activities, they can somehow control the outcome of the game. And while that may have been the case in their own personal life, achieving a level of success in a certain wealth station in life, that doesn't usually translate well to investments, as we all know. So the key here, we think, is it's important to avoid capitulating entirely to the client investment demands. It's okay to yield a little bit, obviously, but if you entirely capitulate, you will be running around following them, not the other way around. It's important to focus on the long term, kind of through repeat, redundant discussions, but emphasize and reemphasize the objective and the long-term plan. And then finally, really it's important because what's likely to happen prior to your involvement is that there's going to be a lot of turnover in their portfolios, which we'll talk about in just a second. It's important to demonstrate the impact that fees have on performance. Showing net of fee versus gross of fees does tend to have a big impact, especially when looking at a longer-term horizon. In terms of building a customized program for this particular client type, we do think, again, that standardized strategies will work, but the ability to introduce a little bit of a layer of customization on top of it usually goes a long way. So you're using a standardized strategy, yielding to them in maybe tweaking it a little bit. When I say tweaking, I'm talking about things like maybe they have maybe a certain preference on a sector or two. They're likely they'd like to have an outlook on a sector or an industry, so putting overweight or underweights on individual industries or securities, putting on things like sin stock, lifestyle type constraints, pre-trade compliance constraints on the portfolio sometimes works as well. It is likely that prior to your involvement, they have probably dabbled in a bunch of ideas, and you will probably have a lot of losses. So it's entirely possible that implementing some sort of ongoing harvesting plan of these inherited losses makes a lot of sense. And in many cases, it puts a very positive face on a negative situation. So you've got all these built-up losses. Turning a harvest into something positive generally tends to reframe the conversation and turn it into something that's a little bit more positive. We think putting cash management bans in place and monitoring cash management works very well. Our platform does obviously accommodate that, so putting in a ceiling and a floor for cash management makes a lot of sense. And then putting a monitoring plan in place so that both you and the client can monitor the spending and tracking to ensure that they stay within those stated bands. So those are the 4 behavior types, and I said this before, I'm just going to kind of repeat it. When we talk about these plans, we're not talking about just investments. We're not talking about just reports. We're talking about the entire interaction profile with this client. So again, very important to tailor the way you communicate, the frequency you communicate with your client based on these 4 different profiles. But so let's assume now that we've got them into the appropriate categories, we kind of have a plan in place for them as it relates to interaction. Now let's talk about some capabilities that we have on the platform as it relates to building investments. So what you won't see here, you won't see managers, you won't see mutual funds, you won't see ETFs, because our platform, as Ty will describe in just a moment, is an open architecture platform. So we're going to provide you with tools, we're going to provide you with a framework to build things, but we look to either you or one of our strategists who can help you fill out these portfolio frames to put in the managers and to tailor it the way that you think it's appropriate. So one of the portfolio construction frameworks that we have is what we call Core Satellite. In the middle, you have usually a substantial beta component. We can do that with, we currently have a number of indices, sometimes between 100 and 150 holdings. Sometimes we can do less. It's a very good place to get kind of a predictable beta. And then around the outsides, you have maybe 4 different satellites, managers who are tremendously inefficient as it relates to taxes, but they're actively seeking alpha and usually leaving taxes in its wake. So one of the things that it does by combining a large beta component with some uncorrelated modules like this, which is all, by the way, done in a single account, one of the things that you'll notice is that it does tend to control the emotional amplitude, it does tend to control the volatility, and dampen the emotional kind of distress related from the portfolio. It does have automated rebalancing, so we can start to move as satellites appreciate. We can kind of rebalance and bring it back to its target weight. And I think the most important thing here is that it's also, at least in a behavioral context, what's very important is it's also very tax efficient. As you can see from those arrows there, the way that we run some of our core satellite programs is that we can let the satellite managers be tremendously inefficient, tremendously tax inefficient, I should say, generating alpha freely. So as they're doing that, they're obviously not concerned about gains. We look periodically to see how many gains are built up. Then we go look to the larger core, and we aggressively harvest losses and suck those losses out of the core component in an attempt to neutralize and offset the gains in the satellite. So again, reducing the overall liability reduces the emotional distress and the amplitude of the volatility around the emotional perspective from the client. So that's one framework that's available for you as it relates to behavioral finance. The other one is really lends itself to what we call mental accounting, and I think all of us exhibit this trait where we tend to look at short-term objectives or intermediate-term objectives kind of in buckets, right? So we'll put our retirement bucket over here, we'll look at our college savings over here, and kind of our charity bucket over here on the side. Each one has its own individual objective, and we usually tend to put its own account. So one of the things that our platform allows is for, let's say, taking that core satellite program and putting it down at the individual investment objective level. So we can put 70% of our contributions into the retirement bucket and so forth. So then we open this view to the client. So the client can log into our platform and say, I just want to see my retirement bucket. And they can look at the 5 sleeves that are inside the retirement bucket. Then they can go flip over their college saving bucket and see the 5 sleeves and see the growth and the contributions and valuations of each one of the sleeves, as well as each one of the overall investment objectives. But then on top of that, we lay down what we call our unified managed household. And what that does for both you and for the client is it allows you to look at things differently. Right? It allows you to look at things more holistically. From an advice perspective, I can now see what my target asset allocation is and where the current allocation is. So I can see where I'm tracking. I don't need to look at it as a big core satellite. I can look at it from a different pie, or I can look at it from a larger core satellite. It does provide discrete visibility into each one of the investment objectives, and it really resonates with most folks who have these mental accounting biases. So that's what we call buckets of money. It's a form of our modular portfolio construction framework. So moving on then, we've now gone through kind of 2 steps of the process, right? So just to kind of recap, we have, at first, we've anticipated and planned. We put each one of our clients into a specific behavior bucket. We know exactly how to interact. We have a plan for how to communicate with them. We built portfolios that are consistent with the way that they think about things, whether they're active or passive, whether they're a core satellite, they're moving around. The last thing we're going to do is we're going to guard against these behavioral biases. We've got them into the right strategies. We've got the plan set up. The first thing we need to do, and I know it kind of goes without saying, we need to engage clients in dialogue that counterbalances their specific bias. So we know what their bias is, and when we talk about communicating, it's not just calling them on the phone, sending them emails. It's also the way we send out our quarterly performance reports. It's the way we send out our monthly statements. It's the way we configure our client portal. It's the entire communication plan, which we argue is much larger than just phone conversations. So we put a profile in place for that particular bias. So all of my friendly followers get the exact same set of reports. All my friendly followers get the exact same client portal. Next, we think it's really important to use specialists. So we do have a platform full of third-party money managers who provide security selection, and then we also have a series of third-party strategists who provide asset allocation, manager selection, research, due diligence, all available for you to pull down, to read, to research, and also in many cases to provide to your client, in some cases even in a white label fashion. Most importantly are the second 2 bullets, though. First, it provides a repeatable, defensible process. And what that means is the 4th bullet. And this is what I call behavioral osmosis, and this happens to most of us. Because we work so closely with our clients and we share some of the same fears, some of the same objectives, in many cases we also inherit some of their own behavioral biases. So if we have a client who demonstrates a confirmation bias, we often tend to exhibit that as well. By using third-party strategists and third-party money managers, there's no relationship with the client, and consequently there's no fear of that behavioral osmosis getting its way into some of our investment decisions. The third is the use of drift-based systematic rebalancing. It's all rule-based, right? So anything that we can set up on a portfolio that's rule-based removes our emotion, eliminates the ability for us to let our own behavioral predispositions creep in the decision-making process. So if we can use rules around systematic rebalancing, Obviously, we're going to be following our client's risk mandate because we'll set the bands up around where their asset allocation bands are. It ensures that we obviously do a buy low, sell high approach to managing the portfolio. And finally, if you need to, you can also set the rebalance bands based on your own tactical opinions. The next thing, and it's also kind of under the theme of rule-based, is we can also layer on dollar cost averaging in and then intelligent periodic distributions out. Again, what that means is we're building rules for the deployment and removal of cash from the portfolio. We're not trying to time. Emotions won't necessarily creep into those decisions. And then finally, we talked about this a couple times. We think tax harvesting is a really important feature to be turned on for accounts, obviously where it makes sense. We think that tax harvesting does a very important thing, and that is it reframes in many cases a negative into a positive. So obviously there's a tremendous amount of value in generating those losses and using them, especially in the market we're in today. So we think layering all those things on top makes a lot of sense, all kind of rule-based, and helps you guard against your client and your own behavioral biases. So that's kind of our three-step plan. I think one of the things that we're going to talk about now is I'm going to, I think the point is that there's a lot of stuff here, right? So we've handed you a lot of information. We've handed you kind of a three-step plan. We've explained why behavioral biases exist, what you can do to counterbalance them in some cases. The key now is really how do you implement it, right? I mean, how do you pull this information down? How do you get your arms around it? The good news is we have a plan. We have a solution for you. Probably the reason you're on the call today. We do have what we're calling behavioral-driven portfolios. The Adhesion Behavioral Driven Portfolio Solution, BDP, which we're going to talk about now. So with that, I'm going to go ahead and hand that over to Ty, and he is going to take it from there.
Thanks a lot, Barrett. I appreciate the opportunity. Yeah, so I think the next step is to talk a little bit about implementation and how Adhesion Wealth can help you implement these great ideas that kind of Barrett laid out for you. So we're going to start by just making sure we're all on the same page and do some definitional kind of review, if you will. So the way that we deliver our investment management solutions at Adhesion Wealth is through a unified managed account. And if you listen to MMI, they're going to tell you that a unified managed account is a single account number that houses multiple managers, multiple investment vehicles, things like ETFs, mutual funds, as well as separately managed accounts, all in this single account number. Essentially, the way that MMI describes a unified managed account, it's a wrapper around your investment solution. Well, we think that that's not enough. We think that a unified managed account should be more than that, and we think that we've developed a solution that allows you to deliver your investment solutions to your clients in a way that's significantly more sophisticated and actually gets to their needs a lot better. So let's walk through kind of our UMA solution and how it kind of differentiates itself from that wrapper that I just described. So the first step is obviously in the design. It's determining how you want to deliver your investment management solution for specific categories of your client base. So typically we think of that in terms of asset allocation and kind of exposure to various areas of the market. So that's always the first step. So coming up with that asset allocation can be done by you, obviously. You probably deliver that currently, or you can use the third-party strategists that we have available on our platform, people who do that asset allocation and have very specific kind of capital markets opinions in kind of building out those kind of allocations. The next step is to expand on that, and then ultimately you want to deliver the best-in-class managers to fulfill each one of those asset classes. And frankly, we're not talking about a single manager per asset class. Quite often, you would want to deliver one or more asset managers to kind of fulfill the full expression of what that asset class can be. So you could have large cap growth represented in both an SMA and an ETFs, for example. So that provides you with a more sophisticated approach and also a very consistent approach to delivering that investment solution that you or the strategist has ultimately designed. So then the next step is to understanding the client, and you want to pull the client's needs and the client's approach to investing into this whole equation. So very aptly described kind of some of those things that are very client-specific that need to be brought to the table. Things like that active tax management to fulfill kind of behavioral investment types. Perhaps the client wants to restrict specific securities or specific industries. You need to bring that to the table. Clients are annoyed by small trade sizes, so you want to be able to eliminate de minimis trades, as well as being able to pull in those unmanaged assets that perhaps your passive investors want to pull in to their investment management solution. So you're going to have to take into very specific account client customizations. And that's where we come in. We provide an overlay portfolio management function and a delivery system that allows you to do all of those things. And delivering that kind of customization in a unified managed account requires judgment, and that's provided by our traders and our overlay portfolio management team. So they're implementing your specific strategies, taking into account client customization levels, and providing ongoing monitoring, implementing those restrictions, doing the full tax management or harvesting, identifying drift and rebalancing the accounts, providing very specific and client-specific customized cash levels on an account-by-account basis, and then also helping with the reporting and the enrollment functions. So altogether, that we describe as a unified managed account in the next generation, if you will. It's an opportunity to provide kind of a systematized and institutional approach to delivering investment solutions, but customized on a client-by-client basis to provide the kind of experience that you want for your client. And that comes right along with being able to deliver the system in a way that's consistent with behavioral-driven portfolios. So we're going to walk through kind of some of the components on how to integrate behavioral-driven portfolios into your practice and kind of the tool sets that we have to help you develop those. So the first would be profiling tools. So as Barrett referenced before, we have the ability to pull in specific behavioral-driven questions that kind of uncover the emotional aspect of your client relationship and how they think about engaging with you and reviewing and experiencing the investment solution that you've designed for them. So beyond just risk tolerance, we want to understand those emotional predispositions. So we have a library of questions that we can make available to you, or you can develop your own, and together we can help integrate that into the questionnaire process. Once you've used this behavioral-driven profiling tools, it'll help you kind of ascertain the appropriate investment management solution for that client, and that'll lead you to providing a proposal. Now, proposals are more than just looking at past performance and projecting future performance given your solution set. We would propose that you look at proposals slightly differently. You're setting the stage for this kind of behavioral-driven relationship that you have with your client. So you want to be more holistic about a proposal as opposed to just having numbers on a page. So we would encourage you to take a broader look at the way you deliver your investment solutions and describe it and deliver it to your client as part of the initial proposal, but also on an ongoing basis, perhaps as part of the reporting package that you put together. We want to make sure that you take advantage and address the emotional side of this by describing what your service model is, describing to your clients exactly how many times you're going to meet with them on an annual basis and what you will cover and that sort of thing. So again, a more holistic approach to delivering your service model and the services that you provide to your client over and above just providing investment management performance. So the output of that proposal and kind of that delivery process are these kinds of behavioral-driven portfolios. And we think that each different kind of behavioral type will have variances or differences in the way that you ultimately deliver the investment management solution. You can, like I said before, you can design these outputs yourself, or we can work together in conjunction to deliver these investment management solutions for each one of the behavioral types. But for example, you may want to have more of a pre-configured investment program for the emotional behavioral investment types, more flexibility, more customization for cognitive investment types, as well as being able to kind of deliver those solutions in a few different ways. Core satellite was discussed as a way to kind of not only address the emotional way that these client types will look at their investment management solution, but also being able to deliver things like tax loss harvesting in a very kind of aggressive and refined way to address other types of aspects of a client's personality type. So once we've determined kind of the models and the investment solutions, then ultimately it's how you're going to interact with your client. So the services that you provide should take into account the behavioral types of the various clients and fulfill kind of the expectations that you set up front. So again, we have the ability to provide tax-aware management. As that means tax harvesting. It could be supporting, non-model, low-cost basis stocks within a model portfolio, and protecting kind of the cost basis of each one of those holdings. We can provide customized cash management at the account level. So you can have a standard for your client, but for your practice, but each client can have a customized approach to maintaining cash levels, which can be expressed as a percentage or an absolute dollar amount. So across your practice, you may want to have a 2% cash level, but you have Mrs. Jones who always wants to keep 10% in their investment management account. We have the ability to deliver that, and that's a service that not only differentiates us, but will differentiate you in the eyes of the client. We also provide those kinds of dollar cost averaging in single decision kind of approaches to investing. So if you have a client who wants to dollar cost average in over, let's say, multiple tax years, over 2 tax years, has existing securities, we have the ability to set that up and do it at the time of investing. So you can set a plan in place, a very scheduled and systematic plan in place to move into the market with existing holdings. Like I said, it can be over a period of time. But the fact is that if you make that determination of that agreement up front, you don't have to go back to your client on a month-by-month or a quarter-over-quarter basis and encourage them to sell out of specific holdings and move into your investment management solution. The same thing happens for distributions. We have the ability to do that on a scheduled basis too. So it's essentially the reverse of dollar cost averaging in. It's dollar cost averaging out. The key here, though, is the single decision point. You don't have to go back and review it with the client on a scheduled basis. It's set it and forget it, and Adhesion takes care of it for you. Now, as far as client management goes, again, you need to keep an eye toward this concept of behavioral-driven portfolios and various behavioral types. So the way that you'd want to do that is through the way that you communicate with your clients. And that, as Barrett pointed out, is all aspects of communication. It's not just conversations. It's also how you deliver information in general. So Adhesion clients all have the ability to have access to a client portal where we'll deliver reports and kind of information about the account that's been entrusted with us. Well, the fact is that we have the ability to design that client portal in such a way that you provide the level of information that's important for that particular client or that particular behavioral type. And so that can vary. As Barrett pointed out, we can provide sleeve-level reporting so that they can see the granularity. The clients that it's important to can see the granularity within their account at any interval. And then in addition to that, you have the ability, we provide you tools to kind of monitor and oversee the way your clients are taking in information and using the tools that you're providing them. So for example, we have the ability to identify when a client actually opens up their client portal and alert you to that fact. We have the ability to identify when clients are taking out cash in excess of certain cash levels that you're accustomed to. So just being able to identify those capabilities across the client base allows you to gauge and monitor and assess the behavioral type that you've assigned to that particular client. So if we can advance from there. We're going to talk just a second about kind of the communication specifically that we deliver to the clients on a monthly or a quarterly basis. So that's the reporting services that we provide. We would suggest that you set up kind of report templates with varying degrees of content and including various types of content based upon the behavioral types for your client base. So there are various aspects of what we do. We would suggest that you can assign any one of these templates to those clients that are most specific and appropriate for the behavioral type that you've identified. So for passive preservers, they may be more interested in the larger picture. kind of asset allocation, household overview, kind of growth of assets, very kind of high-level executive summary. Whereas the friendly followers will look for perhaps different types of information, including drift reports, kind of asset allocations, as well as kind of portfolio characteristics using MPT statistics, those risk-reward statistics. Those folks are more interested in understanding and gathering information. Independent individualists are looking for some of the same types of information, but also looking for the growth of the dollar, taking a look back at the performance and how well they have done historically. So it's a little bit different take on kind of the types of schedules and the kinds of detail that you would include in that particular behavioral type. And an active accumulator may have a top-down view, but also are very interested in the underlying details. And we'll show you a couple of examples of that here next. So the first step, we wanted to show two specific examples just to kind of illustrate what I just described. So for a passive preserver, we described that they have low risk tolerance, they're emotional versus cognitive, and so it's very, very big picture. Here's obviously a cover page. We'll go to the next, and we may want to include a household overview. Again, very graphic, high-level kind of information regarding kind of the way that you deliver the reporting solutions. An asset allocation overview is often very appropriate, and again, a kind of a graphical interpretation of kind of where they are and a snapshot view. And then that snapshot there is appropriate, I think, in that it's very, very high level. So we're going to contrast that with an active accumulator who is, again, more active relative to passive as far as engagement goes, and it does take higher risks, but they are emotionally bent. I think a really good place to start would be this tax alpha kind of report that we've generated. And Barrett, maybe you can just jump in here. You've developed this report very recently, and perhaps you can provide us some highlights here.
Yeah, just real quick, I'll mention, this report is something that we're really excited about. We had a lot of clients who've asked us to do this. This has been very, very well received in the marketplace thus far. Basically what this does, this is a report that graphically and visually depicts how much your client has saved by implementing a tax harvesting tax management program. Basically what it does is it talks about and we don't put these numbers into kind of performance numbers. These are actually measured in terms of what we call liability reduction. So what this is this takes in a bunch of numbers, assuming what your client tax rates are, and it effectively tells you how much your liability was before the tax management activities and what the liability was after the tax management activities. So you can see on a rolling basis, here's how much you would have paid the IRS, here's how much we reduced it to, and here's consequently the savings. And we convert that into what we call a tax alpha number by looking at the market value of the account or the accounts in question. So it's a really good way to visualize and, again, justify the advice that you're providing to your client.
Great. Thanks, Barrett. I appreciate that. And then, obviously, an active accumulator, you would want to round out the reporting package, including things like a household overview here, again, very graphic, as well as asset class performance review. So more specificity and kind of more granularity at the end of the day. So that, in essence, is we've provided you with an overview on the topic of behavioral-driven portfolios and ultimately how you can deliver those and execute them and differentiate not only yourself and your practice. Now, at the end of the day, what we're bringing to the table at Adhesion Wealth Advisor Solutions is a way for you to deliver your investment solutions in the way that you think about your practice. And this BDP approach is just one way that would help differentiate you in the eyes of your client, but also would provide you with an opportunity to do something that's a little bit different and engage in a different way with your client base. So what we're trying to do at Adhesion is to deliver investment solutions, again, in kind of an institutionalized approach, a top-down and kind of structured approach with a level of customization that's unavailable elsewhere. And that allows you ultimately to do what you do best and to fulfill the reason you got in the business, which is providing advice to your clients and being a valued part and trusted advisor for them. So with that, I'll turn it back over to Jack for final comments.
Thanks, Ty. Thanks, Barrett. Great presentation. Folks, thanks for your questions. We've, I think, taken care of most of those online. If you've got more questions about Adhesion Wealth Advisor Services or about behavioral-driven portfolios, feel free to give us a call, 888-295-8351. Hit extension 121, and Ty will be happy to get you to the right folks. Or you can email us at sales@adhesionwealth.com. Thanks again for joining us this afternoon for another great presentation, the RIA's Guide to Harnessing Behavioral-Driven Investing. Thanks, have a great day, and we'll see you again next time.